Good afternoon, everybody. This is your market update for Friday, October 27th, and the volatility in the market continues, both in the stock market and the bond market. Although the bond market this week, I feel like we pretty much ended where we started, so I'll take stability all day long compared to what we've seen in the past. We did have a couple of really good days in the mortgage-backed security market. Earlier on this week, Wednesday was not such a great day due to a GDP reading that was much higher than the market anticipated. But we saw a bounce back yesterday, Thursday, and then that continued positive momentum is carried in the mortgage-backed security market today as well, although not at the same level it was yesterday. But again, I'll take stability all day long. Stock market, not so much. Stock market has really continued to sell off throughout the course of this week. Did start the day mixed for the most part, but pretty close to flat. However, that's changed since then. Dow is currently down 334 points. NASDAQ is still up on the day, really on the back of some strong corporate earnings in the tech sector. S&P 500 is down 21 points. Freddie Mac published rates that came out yesterday for 30 and 15-year fixed, as you might expect, increased for the seventh consecutive week. 30-year is currently sitting at 7.79% on a national level, and the 15-year is up to 7.03%. So about 1/8% increase in both the 30 and the 15-year rates, looking at this week compared to last week. Next week, we do have a lot of economic information coming out, as well as employment-related information. On Tuesday, we've got several home price index reports coming out. Wednesday is the big day. We've got mortgage application data, the ADP employment report, as well as the JOLTS employment report, and also the Federal Reserve meeting culminates on Wednesday, so we'll have a statement and a press conference at the end of that. Thursday, we've got initial jobless claims, and then Friday, we've got the big jobs report as well, so there could be a lot more volatility in the markets next week. I would pretty much bank on it. This week, for the most part, we did see, I mentioned the GDP employment or a GDP report. The reading that came out, the first reading for Q3 of 2023 was much higher than the market anticipated. Shows that consumers spend or continue to spend at a level, that's very aggressive. However, if you look at earnings, personal employment, wage earnings are down. Savings is down, which basically indicates that the consumers continuing to spend, but they are likely spending, either liquidating their savings, burning through that at a rate, that's very aggressive, as well as putting money on their credit cards. It's not sustainable. So that GDP reading that we saw that was, higher than what the market anticipated, it is as a result of consumer spending. But again, being that's not sustainable moving forward, I would anticipate that we're going to see those numbers come down. The PCE report, the Personal Consumption Expenditures report, which is that key measure of inflation, came out today. It was pretty much in line with expectations. There were a couple components that were slightly less, but for all intents and purposes, it didn't move the market too terribly much, which honestly is good. If it had come in higher, the market could have sold off, bond market could have sold off more so than what it did initially, but it did bounce back, and we are positive on the day, currently up 3 basis points. So we'll continue to keep you updated. See you next week, where, again, we've got a lot of information coming out, a lot of volatility. So have a great weekend, and buckle up.